Imagine this. Instead of waiting for your salary once a month, your paycheck drips into your account every second, like a continuous stream. You could buy a coffee, pay your rent, or send money across the world instantly, all from funds that are literally arriving as you speak. That's not science fiction. That's the vision behind Zebec Network. And at the heart of this vision is its token, ZBCN. But here's the real question. What exactly gives ZBCN value? Is it just another governance token? Is it a fee token? Or is it designed to power an entirely new financial system? In this deep dive, we'll spend the next hour breaking down ZBCN's tokenomics, its supply, demand, allocation, burn mechanics, and real-world use cases. By the end, you'll have a crystal clear understanding of why Zebec designed ZBCN the way it did, what it means for adoption, and the risks you should watch out for as a holder or potential investor. Welcome to ZBCN Tokenomics Explained, Supply, Demand, and Use Cases. Before we jump into the deeper mechanics, let's get a quick snapshot of what ZBCN is. ZBCN is the governance and utility token of the Zebec Network. Its maximum supply is capped at 100 billion tokens. The circulating supply, according to major data trackers like CoinMarketCap and CoinGecko, is usually reported between 86 and 92 billion, depending on which tokens are vested, locked, or burned at the time. Price per token tends to look small, in fractions of a cent, but remember what matters is not the unit price, but the market cap. A token with 100 billion supply can still carry serious value if adoption grows. So, ZBCN sits in that category of large supply governance and utility tokens. And everything about its design is meant to support Zebec's mission of real-time streaming payments. 1. Token supply design. Now let's break down the supply side of ZBCN. First, why 100 billion? That's a massive number compared to Ethereum's approximately 120 million ETH, or Bitcoin's 21 million BTC. There's a psychological reason here. A high supply means each token trades at a lower price point. People often feel more comfortable buying millions of tokens at $0.001 than buying 0.1 ETH at $300. It's a perception game, and Zebec designed ZBCN to be accessible and abundant, especially for microtransactions and payroll streams. Second, circulating versus total supply. Even though the max supply is 100 billion, not all of that is in circulation right away. Some is locked for the team, some for ecosystem growth, and some released gradually over time. This creates a key tension. New tokens entering circulation can add selling pressure if demand doesn't keep up. Third, allocation buckets. Based on Zebec's official tokenomics, ZBCN is distributed roughly into these categories: team and advisors with multi-year vesting schedules, foundation/treasury for grants, partnerships, and ecosystem development, community and liquidity incentives, airdrops, staking, farming rewards, strategic investors, and early backers. Think of this like slices of a pie chart. Each slice represents not just ownership, but also timing of unlocks. For example, if the team slice is 20%, but unlocks linearly over 4 years, that means a steady stream of supply entering markets, which can affect token price. 2. Vesting and emission schedule. Tokenomics is not just about how many tokens exist, it's also about when they hit the market. This is called the vesting and emission schedule. Let's say Zebec promised 15% of tokens to early investors. If those tokens unlocked all at once, day one, those investors could dump them immediately, crashing the price. That's why Zebec designed multi-year vesting. For example, a cliff period might mean team tokens can't be sold for the first year. After that, a linear vesting model means small percentages unlock every month. This slow release is supposed to align incentives, making sure teams and backers are motivated to build value long-term rather than cash out early. But for investors, it means always check the token unlock calendar. If a huge tranche of tokens is scheduled to unlock in the next 30 days, that could bring extra selling pressure. 3. Utility and demand drivers. Okay, supply is one side. The other side is demand. And this is where ZBCN gets interesting. Why would anyone want to hold or use ZBCN? Let's list the main drivers. Governance. ZBCN holders can vote on proposals, protocol upgrades, treasury spending, ecosystem grants. This gives ZBCN real decision-making weight, especially as Zebec's treasury grows. Transaction fees and settlements. In Zebec's ecosystem, certain fees are paid in ZBCN. Sometimes a portion of these fees are burned, removed from circulation, creating deflationary pressure. Payroll and streaming payments. This is Zebec's killer app. Imagine you're a freelancer in India working for a US company. Instead of waiting 30 days, you get paid every second in crypto. ZBCN plays a role in powering those payments, either directly or by being part of the fee layer. DePIN and real-world assets. Zebec is positioning itself for integration with decentralized infrastructure projects and real-world asset settlement. In simple terms, ZBCN could become a payment rail for things like bandwidth, energy, or even tokenized property. Staking and incentives. ZBCN can be staked or locked to earn rewards. This not only incentivizes holding, but also reduces circulating supply, stabilizing the market. 4. Burns and deflationary mechanics. Let's talk about burn mechanics. Zebec's model includes burning a portion of fees collected on transactions. What does that mean? Burning equals permanently removing tokens from circulation. Over time, if usage is high enough, burns can counteract inflation from new tokens entering circulation. Let's run a simple thought experiment. Imagine Zebec processes $10 billion in payroll streams annually. Suppose fees on those streams generate 1 billion ZBCN in burns. If emissions that year are only 800 million, the net supply actually shrinks. But, and this is key, if real-world usage is low, burns won't matter much. The burn model only works if transaction volume keeps rising. 5. Real-world use cases. Let's bring all this down to earth with real-world examples. Example 1. Payroll. A startup with 10 employees around the world pays them continuously in USDC, but fees are settled in ZBCN. Every second, small fractions of ZBCN get burned as fees, creating constant demand. Example 2. Subscription services. A creator runs a Patreon-style service, but instead of charging $10 monthly, they stream $0.00038 every second. Zebec makes that possible, and ZBCN is involved in the fee layer. Example 3. DePIN. Imagine thousands of IoT devices streaming tiny payments for bandwidth usage. ZBCN powers those microfees. Example 4. Zebec card. Users off-ramp their crypto instantly to a debit card. Settlement fees again touch ZBCN. Each of these use cases strengthens the token's real-world demand loop. 6. Demand sensitivity and macro risks. Now let's zoom out. ZBCN's success is sensitive to several variables. Product adoption. If Zebec's payroll and card products get mainstream traction, ZBCN demand spikes. If adoption stalls, demand stays flat. Unlock schedules. Even strong demand can't offset massive unlock events. Always track the vesting calendar. Market cycles. In bull markets, microcap tokens can moon. In bear markets, low liquidity assets bleed. Regulatory risk. Payroll and card products are tightly regulated. If Zebec faces compliance roadblocks, adoption could slow. Liquidity. Without deep exchange liquidity, price is vulnerable to manipulation. 7. Risks and red flags. To keep this balance, let's talk red flags. Token concentration. If insiders hold too much supply, they could dump when their tokens unlock. Burn rate reality. Burns sound exciting, but if they're too small compared to emissions, they won't move the needle. Adoption dependency. Zebec's model only works if companies, freelancers, and projects use it. Without real adoption, ZBCN is just another governance token. Exchange dependence. Thin liquidity makes tokens volatile and risky. Remember, tokenomics is half theory, half adoption. Without users, even the best design fails. Here's the TLDR. ZBCN has a large 100 billion supply, designed for accessibility and micropayments. Its demand drivers are governance, transaction fees, payroll streaming, and staking. Burn mechanics add potential deflation, but only if adoption is strong. Risks include unlocked schedules, insider concentration, regulatory hurdles, and low liquidity. Ultimately, ZBCN's future rests not on hype, but on whether Zebec can onboard companies, freelancers, and DePIN projects into continuous payment streams. If you believe in that future, ZBCN could be at the heart of it. If adoption lags, then the tokenomics won't matter. Thank you for watching this deep dive. If you found value in this breakdown, hit that like button, subscribe for more long-form crypto analysis, and let me know in the comments. Do you think ZBCN's tokenomics set it up for success, or is the supply design too big of a hurdle? Until next time, stay curious, stay cautious, and keep learning.